Hello everyone, my name is Blaine Pearson and I am an instructor in Texas Tech's Personal Financial Planning program. In this video, we're going to review the different types of trade execution orders. When an investor decides that he or she wishes to make a purchase or sell an asset or a security, there are several different ways in which that investor can go about executing that desire. The most common way is through and via a market order. A market order is simply when an investor wishes to purchase or sell a security at any given price point, but at a specific time point. So if an investor decides that I want to purchase 100 shares of Apple stock, the investor does not care about what price point he or she purchases that 100 shares of Apple stock. They immediately purchase it at whatever price the market has for that stock. A limit order is when an investor wishes to purchase a security but decides that they have a threshold in which they want to purchase it at. So, for example, in the case of Apple stock, if that Apple stock is trading at $200 a share, that investor may state that he or she wishes to purchase those 100 shares but at $190. So when that Apple stock crosses below that threshold, that limit order will then purchase and guarantee a $190 price point per share for the Apple stock. A sell stop loss order is when an investor owns a security and wishes to sell a security in a stop loss fashion. So, an example of the Apple stock, if it falls through that threshold, it'll immediately become a market order once that price point is reached at whatever price that investor wishes to place a sell stop loss order. A sell stop limit order combines a sell stop loss order and the limit order ideas. So a sell stop limit creates a price floor in which that investor has a minimum that it will sell at. So if, for example, Apple stock is at a sell stop at 190 but has a limit price of 185, if that stock opens, for example, trading the next day at 180, it will not become a market order until it reaches at least 185 through intraday trading. The most common type of order, again, are market orders. The second most common order is a limit order. In this chart here, on our x-axis, we have the months, and on the y-axis, we have price points. A limit order is when an investor has this threshold that, as we discussed before, he or she will purchase a security once it passes that threshold. So, for example, an investor would purchase whenever the security is on the way down here at this price point. I will leave with this chart. This reviews a few of the other definitions of orders that you may hear. Again, this is Blaine Pearson, and in this video, we covered the different types of trade execution orders.